Today's session, the U.S. Economic Outlook, Possibilism and Probabilism with Professor Jason Furman is presented by Harvard Kennedy School Executive Education. Jason Furman is the Aetna Professor of the Practice of Economic Policy jointly at Harvard Kennedy School and the Department of Economics at Harvard University. Furman engages in public policy through research, writing, and teaching in a wide range of areas, including U.S. and international macroeconomics, fiscal policy, labor markets, and competition policy. Previously, Furman served 8 years as a top economic advisor to President Obama, including serving as the 28th chairman of the Council of Economic Advisors from August 2013 to January 2017, acting as both President Obama's chief economist and a member of the cabinet. In addition to articles in scholarly journals and periodicals, Furman is a regular contributor to the Wall Street Journal and Project Syndicate and the editor of 2 books on economic policy. Furman holds a PhD in economics from Harvard University. Thank you for joining us today, Jason. Over to you.
Great. Thanks to all of you for being here. I have 3 goals with our time right now. The least important goal is to tell you what I think about the economy this minute and what I think is going to happen in the economy over the next year. I hope that's valuable. So it is one of my goals, but it's the least important because there's a constant flow of data and a constant set of surprises. So my next slightly higher level goal is to give you a set of things to look at and what to focus on, what to prioritize. So when we're not together 2 months from now, and you need to form your own views, or you want to criticize and have different views than I have at this moment, you know sort of what data to look at, what relationships economically, and the like. And then my highest level goal is summarized in this slide, which hopefully is now sharing with you, which is just a way of thinking about being a probabilist, not a possibilist. And if any of you spent any time here with Richard Zeckhauser or many of the other faculty members, this is a way of thinking that we teach our students at the Kennedy School that is just so important throughout life. And I'll illustrate it in this particular context and talk to you a little bit about how I do it. Now, there's a lot of different things that could happen in the economy. And it's tempting to say this is what will happen, or, this is, what won't happen. It's also tempting for a lot of people, I think, are very tempted to talk about sort of happy possible outcomes. I'll talk about that more. But in the last 2 years, often it's possible we won't get inflation. Oh, wait, we got inflation. It's possible inflation will come down on its own. Oh, wait, it's possible it'll come down with higher rates without it causing a recession. So we'll have a soft landing. So it's always sort of possible. Every one of those statements historically have been true, but in many cases, they haven't been the most probable. And one useful exercise in discipline is to take a set of outcomes that are mutually exclusive and collectively exhaustive and ask yourself what you think the probability of each of those are. So that's what I've put up here, is 4 different possibilities for the economy in 2023. Inflation, and if you're technical and in the weeds, I'm talking about inflation measured by the core PCE, which is the Fed's de facto target, in the second half of the year. So I'm giving inflation some time to come down. It doesn't need to come down right away. Will it be less than 3% at an annual rate, which is not quite the Fed's goal of 2%, but it would mean we're moving there pretty quickly. I think most people would feel pretty good if by the end of next year, inflation was in the 2s, no matter where in the 2s it was, or is it above 3%? Then the other axis of possibility here is whether the unemployment rate maxes out at below 4.5% or above 4.5%. And roughly, this scenario is roughly equal to a recession. And this scenario is roughly equal to no recession. Not how recessions are defined, but sort of roughly correspond to that. So I want you, to the degree you're interested and engaged, to do a bit of active learning together, which is just take a moment and write down 4 numbers. I'm not going to call on you. I'm not going to grade your answers. If your 4 numbers don't add up to 100, they're definitely wrong, and you're thinking about it wrong. If your 4 numbers add up to 100, you might be right. And we could have an interesting argument about whether you were right or my numbers were right. So just take a moment. Think about these 4 scenarios, write down 4 numbers that add up to 4, add up to 100. So now when you listen to me talking, you can figure out, am I using different words than you might have used? Or do I have a different view of the world? Because if your numbers are different than mine, we have different views of the world. You then want to hear what my views are and decide whether you want to update in my direction, or, found what I said convincing, unconvincing. You had a set of considerations I ignored, and you want to stick with your number or go somewhere in between. And by the way, this is something I do with friends of mine routinely. I get us to write down numbers, my numbers, their numbers, write them down separately, and then we have a discussion after we do it. So grand reveal here, drum roll. These are my numbers. To be clear, this is not, a unified macro computer, large model of the economy or something like that. I do some small models of the economy that I put together and run. I read other people's models of the economy. I listen to the arguments others make, and this is a synthesis of that. I never believe people who just have one model, one way of looking at the world. I'm much more interested in synthesizing lots of ways of looking at the world. So I put a soft landing at 9%. I'll explain why I'm relatively dark about that. Most of my probability mass, 71%, is in this column, because I think inflation is very, very inertial and will be hard to get inflation down. I'll talk about why I think that. As between, we have a recession. We have no recession. And we have a recession. I'm less sure. But note, I have much more here than here. This one is a recession that gets the job done and brings inflation down towards its target. This is something, stagflation or incomplete hard landing, is something where you have a recession, maybe inflation comes down, but it's still above 3%, and so you still have quite a lot of work to do. So a lot of what I'm going to be doing now is giving you some of the logic and thinking that went into these subjective probabilities. Before I do that, I want to rant about the year 2021, because I think understanding what went wrong in 2021 is important to make sure we're not repeating the same mental errors in 2022. This picture and quote is a famous quote from Queen Elizabeth II, who, after the financial crisis, asked a group of economists, why did nobody see it coming? You're all economists, you all study the economy, why didn't you see it coming? In some way, I have more sympathy for the economists who didn't see the financial crisis coming than I do for the economists who didn't see the inflation coming. Financial crises have a certain unpredictable aspect to them. There's a certain efficient markets logic to, if you knew the stock market was going to fall tomorrow, you'd sell today. So the stock market would sell today. So wherever it is, incorporates all the information. There's no such efficient markets logic for inflation. There's no reason why inflation should be unpredictable. And yet the inflation was not predicted. This is the survey of professional forecasters, a group of leading forecasters. This is from May 2021. So at that point, the fiscal stimulus had already fully passed. The vaccines, we roughly knew what they were like, but Delta was already growing. This is the year 2021. This is the year 2022, and it's core CPI inflation. Core CPI takes out food and energy. So things like Russia's invasion of Ukraine driving gas and food prices up may pass through to core CPI, but they probably don't pass through that much. And and they're not directly shown in it. Forecasters thought the most likely number was 2 to 2.4. That one had the highest probability. And then notably for this year, they thought the chance of deflation was 0.6%. They thought the chance of inflation above 4% was 0.4%. Now let's look at what actually happened. Core inflation last year was 5%. 5%, remember, this was a forecast that was made more than a third of the way through the year. And the odds that it was above 4 were basically put at 0, and it ended up at 5. This year, we have 2 more months of data that we need, but it's almost certainly going to be above 6%. So not only did forecasters' central estimate miss it, they attached very, very low probability to it happening. And that's a general lesson in life, by the way, that forecasters, not just economic forecasters, all of us as we go about our daily lives, are more confident than is justified. We have narrower confidence intervals around any forecast, which means things we think only happen 1% of the time tend to happen a lot more than 1% of the time. Forecasters missed it again and again and again. This is a little complicated to explain. I'll do it quickly. Don't worry if you didn't follow it. This is the Federal Open Market Committee, the Fed. And this is the easiest one to understand. In September of 2021, they forecast that inflation for the year 2021 would be, I don't remember, but it was something like 2.5%. Now, they already had the data for the first 8 months of 2021 when they made that forecast. And so when they said inflation was going to be 3% or whatever they said, that was only a forecast for the last 4 months of the year. And it was a forecast that in the last 4 months of the year, inflation after raging all year will be 1.3% for the rest of the year. The FOMC's June forecast would only have come true if inflation for the rest of the year, which was the only uncertainty facing them, was 1.5, et cetera. So when forecasters were talking about transitory inflation, both the Fed and private forecasters, they did not mean inflation's eventually going to get to 2. They meant inflation's going to turn on a dime and suddenly be much less than 2. And that's going to happen instantly and in a really large way. The orange bars are what actually happened. So why did forecasters miss it? I think they were being possibilistic, not probabilistic. They were saying things like, oh yeah, there's a lot of fiscal stimulus, but the multiplier is low. Or, oh, there's a lot of monetary stimulus, but probably won't cause inflation. They were saying the supply side of the economy would just be perfect by the middle of 2021, able to make everything that everyone wanted. There'd be no additional COVID waves, no major geopolitical events. Everything with an unusually large price increase would normalize, while everything with small wouldn't be a problem. And that wages, which were growing very quickly at the time, would stop growing quickly. Every one of these is possible. The chances that all of them are true simultaneously was never particularly probable. You needed everything to work out perfectly for there to be no inflation. And so this was an example of people being sort of wishful thinking around what was possible rather than thinking hard about, this. This is like the best case assumption. What's the chance the best case assumption happens? Maybe 15%. This was a best case assumption also. What's the chance that happens? Maybe it's 15%. What are the chances all your best case assumptions happen simultaneously? Well, a lot less than 15%. Now, this is a way of thinking that I think in some quarters is repeating itself now a little bit less severely than it did a year ago. Not to brag, but I created both of these wonderful artworks. I don't just do economics. I also know how to go to OpenAI's website, DALL-E, and ask it to draw me pictures of planes crashing and soft landings. And this is what it generated for me. And that's the big question. In fact, there's the 4 questions I had before, the 4 different possibilities: soft landing, continued overheating, hard landing, or the 4th one, which is stagflation or incomplete hard landing. Now, sometimes I read economists who I really respect a lot, who have a different view or seem to be writing about a different view than I have. Alan Blinder, who's a fantastic macroeconomist, wrote a long essay in the Wall Street Journal in which he really emphasized the possibility of a soft landing. Said it was surprising. The Fed really surprises by being able to engineer these. Goldman Sachs and their chief economist, Jan Hatzius, has been really, really sort of consistent leading edge of releasing analyses saying that we're making progress towards a soft landing. And when Goldman writes one of these notes, the next day there'll be 10 news articles. Goldman's view is we're going to have a soft landing. So sometimes people say, Jason, why are these people so optimistic and you're not? What do they know that you don't know? So I read them carefully and I come away a little bit puzzled. Because this is what Alan Blinder wrote in that essay. To be sure, landing the economy softly is a tall order, but success is not unthinkable. Jan Hatzius at Goldman Sachs, the U.S. economy can achieve a soft landing, even though the path is narrow. Now, not unthinkable and path narrow, those are words. It's hard for me. I don't really know what those words mean. What number is associated with them? I told you my probability of a soft landing was 9%. Is not unthinkable 9%? Is a path that's narrow 15%? I don't really know. It's possible that I have the same view as Alan Blinder and Jan Hatzius, but that they're spending more time talking about the 85th percentile of the distribution of outcomes, the sort of happiest end of the spectrum, the good case, and I'm spending more time talking about the 50th percentile of the distribution. In fact, if I wanted to talk about another area of outcomes, I'd probably give you the bad case. Sort of the most important thing to know is the middle case. The second most important thing to know is the bad case. And finally, if there's time left, we can talk about the good case. So what would we need right now for a soft landing? A little bit like last year, there's a lot of things that need to go right, all of which are possible. I'm not sure collectively they're probable. You can take a bottom-up perspective. A bottom-up perspective on inflation, which is also a micro perspective on inflation, and say inflation for some items falls a lot, but it doesn't rise for others. That is the way a lot of people look at it. They tell a lot of different stories. Here's what's going on with cars. Here's what's going on with hotels. Here's what's going on with housing. Let's add that all up to inflation. In theory, that should give you the inflation rate. In practice, inflation is such a macro phenomenon that approach has often not worked very well. Top-down perspective is looking at it more from the perspective of macroeconomics. What's going on in the labor market? What's going on with wage growth? What's going on with inflation expectations? And then finally, another assumption in all of this is no new unfavorable shocks. So let me take you through all 5 of these, starting with this forecast. Forecasters generally think inflation is coming down. This is for 2023. The Fed and the Survey of Professional Forecasters see inflation of about 3%. The market is pricing in about 2.4. This is for the entire year. If they published, which they don't, a forecast for the second half of the year, it almost certainly these would be below 3% in H2. So largely they think inflation is coming under control. Now, the market, at least, is not necessarily in the soft landing category. There's not a great way to read off market predictions of a recession, but probably the best way we have is by looking at the yield curve. And right now the yield curve is inverted, which is to say the 10-year treasury is lower than the 3-month treasury, which happens when markets expect the Fed to be cutting rates a lot in the future, which happens when markets expect there to be a recession. And this yield curve inversion is basically as large as we've ever seen, except in the early 1980s, when, by the way, there was a very severe recession. So the markets and forecasters seem to think inflation is coming down, but think maybe it's coming down because we're going to have a recession. So let's look at the data. People like to every month slice and dice the inflation data. It sometimes drives me crazy because if you have an optimistic view of the world, you take out all the high price increases, you keep in all the low price increases and you say, look, inflation isn't to be worried about. The point of this picture should not be that you're calling out each of these separate lines. It's a blur. These are median, trim mean, excluding food and energy, and housing, excluding food and energy, just including the market-based items. It's a lot of different ways of looking at it. But the main lesson of these lot of different ways of looking at it is they all sort of are moving roughly together. They're all clustered around 5%. When the Fed has a target is 2%. And sort of no matter what you sort of add in and take out, unless you're doing it in a very biased, rigged way, you're getting about the same answer. Now, there are some prices that look quite favorable. This is shipping costs. And shipping costs have come way down and are pretty normal right now. This is inventory to sales, excluding motor vehicles. That's also pretty normal right now. It's roughly on the trend it was on prior to COVID. And so businesses have a lot of inventories. They may at some point want to unload those inventories. And to do that, they'll lower their prices. The goods inflation has actually come down a lot. Last year, it was 12% through January, slightly unorthodox year. This year, starting in January, goods inflation has been 2.5%. So goods inflation came way down. The problem is, and this is core, so I'm excluding food and energy. The problem is services inflation came up. And services are 3x, 3 times as important as goods. And so overall core inflation was unchanged. So we got the improvements in goods markets we were hoping for, but it didn't get rid of the inflation. Why? Because we got inflation somewhere else. And that's one of the limits of this bottom-up approach. Now, right now, the thing people are most counting on is housing. Why don't you just focus on the gray? That's private new rent increases on the right axis. New rents were growing at 25% annual rate. Now they're basically barely growing at all, maybe 1, 2, 3%, depending on the measure that you're looking at. The way inflation is measured, this doesn't fully show up in the data yet, but it will eventually show up over time as people's leases renew and they renegotiate them or they move. The problem is there's some other prices that might go the other way. If I had to bet, financial service prices are going up faster than they were in the last year. Health prices are going up faster than they were in the last year. So from a bottom-up perspective, there'll be some puts and takes, and it's hard to sort of add up how all those puts and takes will work. So let's now do a top-down macro perspective. And the first really important question we want to ask is, will there be an immaculate loosening in the labor market? So what does that mean? The unemployment rate right now is 3.7%. That's about where it was prior to COVID. That's probably, if that was all you knew, you'd say the labor market just isn't that tight. You just wouldn't be that worried. The reason to be worried is last year, any of you that walked around saw there were a lot of help wanted signs. Any of you that talked to a business owner knew they were trying to hire people, and you saw that in the data too. Job openings have come down a little bit, but they're still higher, way higher than there ever were prior to COVID. Quits, which this is not, sorry, I have a little bit of a cough here. This is not the Great Resignation. Sorry, let me stop a sip. Quits is not the Great Resignation. When you quit your job, you almost always are going to another job. So when you're confident in the labor market and there's a lot of jobs out there, you quit a lot. You go get new jobs, you get a raise in your new job. Quits have come down also, but they also remain higher than they were prior to COVID. And the question is, can these both continue to fall without the unemployment rate rising? That would be the immaculate loosening in labor markets. That would be the happy scenario, is labor markets cool down, not because more people are unemployed, but just because there's fewer help wanted signs. Now, this has never happened before in our history. You've never seen something like this happen. And so I don't make it my central case, my 50th percentile of good and bad outcomes. Now, this has never happened before either. So I do think anything is possible. I think this is possible, but I don't think it's probable because I don't want to make, when I list sort of all the outcomes from best to worst, I don't want to take the best outcome and say it's right in the middle of the distribution. I want to average across a range of outcomes, many of which involve openings remaining high unless the unemployment rate rises, and that brings openings down. Now, how high does unemployment need to go? Working with a model from some other economists, Larry Ball, Dan Lee, and Prashi Mishra, I sort of took their model and readapted it to my assumptions. And my estimate was that you need a 6.7% unemployment rate for 2 straight years in order to bring inflation down to 2. Now, huge uncertainty around that estimate. I do not think the Fed should try to automatically raise the unemployment rate to 6.7 and keep it there for 2 years. This is not a recommendation. This is what policy does. But this is a reasonable guess as to what might be needed in order to get inflation to 2. Now, we may get luckier, and I think it would be fine for the Fed to continue sort of pushing the boundaries and see if we get lucky, and this is overly pessimistic. It might be that we don't want to get the inflation rate all the way back to 2, and we can talk about that more. But it might be that on the menu, this is one of the options, and all the other options with lower unemployment are options for higher inflation. Third perspective, wage growth and price growth. There's a big debate over whether or not there's a wage price spiral. It's an incredibly annoying and useless debate because no one defines what they mean by wage price spiral. I like to think of wage price persistence. And we'll talk about it mostly going one way, but it goes both ways, which is when a business has its costs go up, they raise their prices. When the price of chicken wings goes up, the business sells their chicken wings for more. When the price of the waiter to serve the chicken wings goes up, the business also raises, the restaurant also raises the cost of chicken wings. So compensation growth is a big cost for businesses. It feeds into prices. You can link inflation just as a matter of identity, something that's definitely true, at least if you define the terms properly, that whenever you raise compensation, you have to raise prices by the same amount, except to the degree your productivity increases, and then you don't need a price increase, or your profit share decreases, in which case you don't know you don't need to do it. The profit share increase, the best forecast of that is going to be 0, so I'm going to cross that term out. Productivity growth, the best forecast of that is 1.5 fixed, so it's just become a fixed adjustment. And so we're basically left with this one-to-one relationship between inflation and compensation growth. So let's look at where compensation, or in this case, wages, are growing. This is average hourly earnings. They're the monthly number. When this number came out for November, it was eye-popping for people. It was much higher than they expected, and it caused some upward revision. For me, the bigger deal was the originally published numbers for September and October were something like this. This was the original September number, and it got revised up. This was the original October number, and it got revised up. September and October got revised up by 1.2 percentage points. So instead of a pattern of wage growth slowing, you have, if anything, a pattern of wage growth staying the same, possibly even increasing. Now, these numbers are noisy. They bounce around. There are a bunch of quirks in the November number, so I don't want to take it too far. But at this point, if you look at the 4 measures of wage growth that I pay the most attention to, there are 3 of them are all growing in the mid-5s. This one is defined differently, and it's growing at 6.3%. It only includes people who stay in the same jobs, and it doesn't include an influx of younger workers. And you ask historically for each one of these series, when you had the wage inflation rate showing here, what price inflation did you have? You had price inflation in the 4s. Every one of these different wage measures is showing us price inflation anywhere from 4.3 to 4.9. So it is possible that this wage inflation will come down on its own, even without labor markets loosening. Historically, though, that isn't what's happened. What's happened is labor markets loosened, and that's why wage growth comes down. It's also possible that you could sustain this wage growth without price growth if we had a huge productivity burst or companies were willing to absorb the cost. But again, I don't think that's probable. Be faster on this one. Inflation expectations. You hear a lot about anchored inflation expectations. If you look at long-run inflation expectations, they have moved up a little bit, but they're not worrying. If that was the only data, we'd all be fine. But you look at shorter run expectations, and they've risen quite a lot. Which one of these matters? It's possible that the only one that matters is long-run inflation expectation. The statistical and modeling evidence is ambiguous. We can go into that in the Q&A. So what do? I say there's sort of some chance this is what matters, long run, some chance this is what matters, short run, and I basically sort of weight them implicitly. Finally, we've been talking about all the predictable things in the economy. One thing the economy does is surprise us. If you ask me to predict what the surprise will be, will it be Europe's COVID wave or the wave we're going through right now? Some tension in Taiwan, Ford CEO. This one actually we can take off the list because it was settled. One of these could happen. It could cause a lot of inflation. Am I predicting any one of these three happen? No. My guess is if we get back together a year from now, none of these happened. But there was something else that I didn't forecast, that the newspapers didn't forecast, that did mess everything up. Maybe a war, tensions in the Middle East, something with Iran that comes out of the conflict with Russia and Ukraine. So to summarize, I think a soft landing is possible with inflation falling for goods and housing and not rising for other things, with the labor market returning to normal from pre-COVID, with wage growth slowing as a result of it, and that translating into price growth, and all of this undergirded by low long-term inflation expectations and no new favorable shocks. I just don't think they're probable, which is why my judgmental summary was this: the 9% soft landing, 34% continued overheating, 20% hard landing, 37% stagflation. So what does this mean for the Fed? At least as of, sorry, I didn't update this. This was as of last week. It's actually shifted a little bit since then. There's an expectation that interest rates, which are now a lower bound of 3.75, now most of the expectation actually is here, that they're only going to go up another 100 basis points, 50 at the meeting next week, and then either 25 or another 50, and they won't go up much more than that. I personally think 500 to 525 is closer to right, given my diagnosis of the persistence of inflation. More importantly, I think 600 plus is actually possible. It's very possible. I also think this may not be once and done. We may raise rates, slow the economy, inflation comes down, rates get cut, but inflation doesn't come down enough. And so we need another tightening cycle. So I wouldn't assume when the tightening cycle is over, it's over. This could be multiple attacks at this target. Why might the Fed end? Inflation might come down. I think by itself, that's actually not enough that's enough for the Fed to stop raising rates. I don't think they're going to cut rates because inflation comes down. They would need unemployment to go up in order to cut rates. Even then, it's not guaranteed. I think it would need to go above 4.5% before they even have a serious conversation about it. The financial system could break. I confess I'm a little bit less worried about this. It might be that I'm a little bit less knowledgeable about this issue. I think for the most part, the Fed will just keep going. And if the financial system breaks, it will deal with it. And the global economy could break, which I'm sad to report is not something that is incredibly central to the Fed's thinking, except insofar as it spills back on the United States. So in summary, in terms of my macro views of where they are now, a decent amount of persistence of inflation. It's going to be hard to get rid of. Rates will probably need to go higher than they're expected right now. Next week, we're going to get a hawkish 50 basis point increase from the Fed, which is it'll be 50 basis points, but they'll signal a lot more. I don't think they're happy with how much financial conditions have eased. I think lots of different things are possible. And what I'd keep your eyes on are core inflation, job openings and quits, and what's going on with wage growth, especially the best way to measure it, which is the employment cost index. And then to end on that highest level conclusion from all of this, be a probabilist. Use numbers. Don't use words. Don't say narrow path. Don't say not unthinkable. Put your subjective probabilities. Otherwise, we don't know what those words mean. Don't make your analysis based on everything goes right and nothing goes wrong. Don't think that the best case outcome, you list all the outcomes from worst to best. Probably don't put the best as the 50th percentile of what could happen. And finally, and this one's easier said than done, recognize you don't know the answer. Humans are overconfident. Don't be overconfident. You might want to plan for the median or the middle outcome or the mean outcome or the mode, whatever, some central tendency. You might want to plan for the worst outcome and build your planning around hoping for the best, planning for the worst, but recognize that uncertainty and then figure out how to integrate across it. So thanks for listening to this discussion. I saw an awful lot of hands go up while we were talking, and we have, I think, about 22 minutes to get through, hopefully, all the questions that you have.
Thank you. So we'll now move into the Q&A portion. Please raise your hand if you'd like to ask a question live, and we'll call on you and ask you to unmute. As a reminder, you can also submit your question using the Q&A function, and we'll address as many as we can before noon. Okay, I will start with a question from the chat. What role, this is from Alex Davis, what role does increasingly dramatic wealth inequity have in all of the labor/wage issues you've raised?
So I think that inequality is a really important issue. I've done a lot of research and writing on it, teaching on it, and the like. It doesn't interact in a very huge way with what we're talking about right now. First of all, inflation imposes pretty broad-based pain. There's some debate about whether it imposes more pain at the top or more pain at the bottom. I think a lot of ways, the most vulnerable families are the ones that can least afford it. So even if it's disproportionately painful for the wealthy, how much is their lives going to change compared to someone whose income is more modest? So I do think getting inflation down is important. The Fed's tools have distributional impacts, but they're hard to predict. In fact, so far this year, the brunt of the adjustment of the Fed rate hikes has been on the wealthy because stock prices and bond prices have fallen so much. And so there's actually been more of a reduction in wealth inequality this year so far than any year on record. To be clear, that's not the Fed's goal. To be clear also, I think there's more pain that's going to spread out more broadly in the economy as the Fed works to tackle inflation. But that's where we are right now. Now, if we could bring fiscal policy in to deal with inflation, that would be ideal, government spending and taxes, because then what you can do is give a bit of extra money to families with children that are struggling, give a little bit of extra money for nutritional assistance, help protect the most vulnerable at the same time that you're raising taxes on, the top 1/3 or half of households in order to bring inflation down. So with fiscal policy, you can achieve better tuned fiscal distributional impacts. Monetary is very blunt and just can't very much.
Okay, thank you. Jafar Al-Rakabi, would you like to unmute yourself and ask a question?
Sure. Hi, Professor. My question is about the role of fiscal policy. Professor Bianchi has argued that basically fiscal explains trend, sort of changes in trend inflation, and that if you want monetary policy to not have huge losses in output then you really need to change the fiscal stance and be much more sort of fiscally sustainable. Just your thoughts on sort of the role of fiscal policy in sort of in managing inflation.
Yeah, so fiscal policy, especially in the United States, but to some degree in a lot of other countries, has played a role in getting the inflation started. At this point, it's helping perpetuate it. People still have money left over from 2 years ago, but it's only helping to perpetuate it, and other things are more important, like monetary policy and self-fulfilling inflation. But initial spark, a lot of it, especially in the United States, was fiscal policy. In terms of how to deal with it, it's just a reality that in most countries, the central bank is reasonably rational. Doesn't mean it's always right. I think the Fed got things wrong last year. I think the ECB did, but they sort of are pretty technocratic, and they can correct their mistakes relatively quickly and clean them up. Fiscal policymakers are just sort of, frankly, having spent a lot of time with them, maybe even been one myself, can be a disaster. Just totally irrational, political, all over the map. And they definitely can't do something like the central bank does of meeting every 6 weeks to adjust to new conditions. So in general, I think there is a good reason we think the Fed is the primary line of defense, or the central bank, depending on your country, for inflation, for output stabilization. But I do think inflation is high enough right now, it's causing enough pain, that I would make an exception and I would have fiscal policy help. But it would still be the central banks playing the central role. But what fiscal policymakers would be doing would be providing targeted relief to those who are most hurt by the economy, while helping to take steps to slow inflation.
Thank you. Okay, the next question we'll take live from Khalida Nasreen. Khalida, would you like to unmute yourself, please?
Yeah. Hello.
Hello, I hear you.
Yeah, in Bangladesh situation, and then would you please explain the condition we are facing now, actually regarding what step we can take, for monetary or fiscal policy, which will be, convenient for us to handle this situation. And thank you so much.
Yeah, so Bangladesh, like most countries in the world, has seen a big increase in its inflation rate. In Bangladesh's case, a decent amount of that increase is imported. It's because the price of food and energy has gone up because of events totally outside the control of Bangladesh. And the price of goods have gone up, in part driven by U.S. Consumers. I'm not familiar enough with the day-to-day details of Bangladesh that I would presume to tell you what exactly you should do. But, the country has been raising its interest rates. It needs to, in order to both bring inflation down and ensure there's not a big depreciation against the dollar. What I'd want to know is, what I don't know off the top of my head is Bangladesh's fiscal situation. So ideally,
actually here we are facing, facing here reserve constraint and in shortage of reserve. We have foreign reserve like dollar. This is too much high here, as well as supply side or inflation also is so high. So in that case, our interest rate is as it was before. What here our government takes some austerity measures, but I don't think so. In long run, I think people are hoping that we'll cope with the problem. As government is taking austerity measure fiscally, but in monetary, if you think that our interest rate is still not stable, didn't increase much. So in this situation, we don't know what is going to face our country.
Yeah, so I'm just going to say one more thing that's generally relevant to emerging markets, because there's probably a number of people from emerging markets here, which is and then we'll move on to the next question, which is, in general, the dollar has gotten much stronger, which means if you as a country borrowed in dollars, you have a tougher time right now repaying that. It costs you more of your local currency for it. So you have to mind your exchange rate a bit more. If you haven't borrowed as much as in dollars, that gives you more flexibility to take advantage of a depreciation in your exchange rate, which can help strengthen your economy. So you really need to look, the emerging markets are just so different, every one, in terms of questions like how much trade do they have with the United States? How much debt do they have denominated in dollars? You need to look at all of that.
Yeah, thank you so much.
Okay, thank you. We're going to take a question from the chat at this point. With the economic slowdown in the U.S. as a result of rise in policy rates and other measures to contain inflation, what are the major shocks that we can expect in the global economy, especially its ramifications for developing countries?
So I partly actually just addressed that a little bit with what the United States is doing is driving up the dollar. I think some people overstate how bad that is for emerging markets. It really depends. Turkey's exchange rate, the dollar has strengthened a lot against it. That has much less to do with the Fed and much more to do with the way President Erdogan is managing monetary policy by doing like the exact opposite of what we teach students to, with very bad consequences for Turkey. Brazil and Mexico have both seen their exchange rates actually strengthen against the dollar. So I think that the U.S. and global interest rate tightening is creating real challenges for emerging markets. I think economic policy is much harder to navigate when you have fewer degrees of freedom and when capital is as mobile as it is and just sort of for no good reason will move, or for just a small reason will move from one place to another. It can become very hard. But I think we shouldn't overstate it. And unless the United States gets its inflation down, we're not going to have a stable global economy. And I think a lot of foreign policymakers that I've talked to in central banks and treasuries ministries understand that the United States needs to, doesn't really have a choice about this. By the way, can I, Laura, I see another question in the chat from Joe Zhao. Could I do that one?
Please go right ahead.
Okay, great. And I'm going to put up a slide as part of the answer. So Joe asks, first he says, thanks a lot, Dr. Furman. So thank you for being here. He says, Dr. Jeremy Siegel from the Wharton School talked about the lagging effect of the CPI number, CPI housing numbers versus real-time Zillow numbers. Could the lagging effect of the CPI numbers be misleading in the policymaking of the economists at the Fed? So one reason I like this question is it allows me to go back to one of the slides I showed you, but this time talk about the part that I skipped over last time. So putting my slides back on, erasing all my markings. And here are two different measures of inflation. The blue one is the official measure. That's how inflation is measured right now. And it looks at everyone who's in houses, what they're paying in rent, or what they're implicitly paying in what's called owner's equivalent rent, which assumes they're paying the same rent that they would be paying in the market. In the orange one, I do something myself where I take the official numbers, swap them out, and swap in a combination of Zillow, which you referenced in your question, Joe, and apartment list. Those are spot rents. That's if you had a new lease last month, what happened to its growth, not if you stayed in your house, because most people's rent doesn't change every month. This is if your rent did change, how did it change? When you do the swap, you get an inflation rate using the Fed's measure of about 4%. When you don't do the swap, you get an inflation rate of about 5%. So this issue of spot rents versus overall rents does matter. But even if you use the Zillow numbers instead of the official numbers, the overall inflation rate is still running 2 points above the Fed's target. And I don't think this is enough to not do anything. And I would also add there's other factors that go the other direction, like health and financial services, where prices are probably going to increase more in the future. So Laura, back to however you want to manage things.
All right, thank you. I think we'll take a live question from Gabenga Babad. Benga, if you wouldn't mind unmuting yourself, please.
Hello, can you hear me?
Yep.
Yeah, thank you very much, Prof. basically in Nigeria, our Federal Reserve, which is our central bank, they've adjusted our interest rate and tailored it towards the Feds in US in terms of our inflation going up. But my question is, to what extent or to what degree, when will they stop? Because the interest rate, they keep adjusting it up and up just to guide against the inflation in the economy. So at what extent or at what point will they stop? Because on the other hand, yes, they are trying to guide against inflation, but also it's also killing the local industry in Nigeria. So things are just very tough because the prices are so high. So at what rate will they stop? That's what I'm asking. That's the question.
Right. So I don't have an answer to you for Nigeria. I think Nigeria, I'm pretty sure, actually started raising rates even before the United States did. Most emerging markets did. Very few countries are done with their tightening cycle. In most countries, it's expected, though, that rates are going to go up by another between 0.5 percentage point and 2 percentage points. So I don't know if that applies to Nigeria, but that's sort of globally what's happening. And Nigeria, like other countries, is dealing with two things. One is for its own domestic reasons, it is trying to slow the economy to bring inflation down. The second is it needs to worry about its exchange rate in a global economy and not have interest rates be too super different in their trajectory than the rest of the world's. And both of those so far have been pushing in roughly the same direction. And certainly that second consideration for Nigeria would say, there might be more of an increase, but not much more. The other thing I should say, though, is what matters everywhere in the world isn't what the central bank's policy interest rate is. It's what the mortgage rate is, or the borrowing rate for the companies, or the value of the stock market, things like that. And everywhere in the world, that prices in, the expectation of further increases in the policy rate. So when the Fed raises rates by 50 basis points next week, which it probably will, that's actually not going to raise borrowing costs for anyone, because the borrowing costs that matter have already gone up in anticipation of what the Fed was doing.
Okay, thank you. We'll go to the chat. In hindsight, what is your view of the main drivers of labor shortages that we saw in 2021? Could that diagnostic shed light on how likely the open vacancy line is to go down substantially and quickly?
Yeah, the biggest one is the lack of immigrants, some of which started before the pandemic with President Trump's policy. And then the pandemic itself dramatically reduced people's moving from country to country. And then the United States processing those moves. The second biggest factor at this point is men over the age of 55 who prematurely retired or didn't, in many cases, unretire, where you retire for a year or two, and then you come back in. My best guess is that neither of those factors are likely to change dramatically on the time scale that's relevant for inflation. So I would love nothing more economically than more immigration. I think it's the single best policy we could do for the US economy. If I was making a forecast, I would not assume that a whole lot of immigrants show up in the next 6 months, which is what you'd need to get inflation under control.
Okay, thank you. We'll take a question from Aswadi Varghese, if you wouldn't mind unmuting yourself, please.
Oh, you're still muted. Oh, Aswadi, it looks like you're muted.
Hello, Professor.
Oh, now I hear you.
Professor, I want to know that how economy, I'm from India, and I want to know that how social economy affected the commercialization of product and how macroeconomy affect the inflammation.
So I don't understand Would you want to give me one more sentence on your question? And I may not know the answer, but.
Professor?
Just to explain it a little bit more.
Actually, I'm having some net issues. That's why I cannot complete it. Professor, my question is that for the commercialization of product in market, how inflammation affect and how social policy can develop a country higher level?
Right. So issues like that, like social policy and commercialization, are incredibly important for the question of medium and long run economic growth. Today, I've been talking about short run macroeconomic management, how to navigate the inflation, navigate the interest rate increases and all of that. And so to some degree, those two issues are disconnected. And yours would take almost a whole new lecture to do justice to. But it's a really great and important question.
Thank you, Professor.
Okay, thanks. We'll go to the chat for this next question. What is the impact of the reduction of the Fed's balance sheet size? Is that more or less important than interest rate hikes?
If you trade like certain very specific types of securities with a certain very specific maturity, and you're in financial markets, the Fed's shrinking its balance sheet, it's selling its assets, really important to you, and you're mesmerized by it. If you're looking at what matters for the economy, like what are mortgage rates, what are long-term borrowing costs, whereas the stock market, the path of interest rates is much, much more important than what it's buying. The other thing is the Fed basically set its selling. The Fed set its asset selling basically on autopilot, and there's no expectation they're going to adjust it. Whereas the interest rate path, they adjust quite frequently. So I'd keep your eye on the interest rates unless you're a very specific trader, in which case you need better information than all of this.
Okay, thank you. And we'll take our last question from the chat. Is the business community paying enough attention to the economy and inflation? Everyone is pointing to the government.
I think that the business community just maximizes subject to the constraints it's under. And so if you print a lot of money and create a lot of demand, more customers show up, they're going to raise prices. And so I don't like when people talk about inflation as sort of responsibility or morality. It's not workers' fault. It's not businesses' fault. They do what they do when the Fed sets interest rates in this way or Congress sets fiscal policy in that way. And so I do think ultimately it is the government, and it is in particular the central bank in any one of the countries represented on this call, their responsibility to get inflation under control.
Thank you.